Hello students, so welcome to this session and we are together for the ICWA final paper 20A, which is about strategic performance management and business valuations, in short called as Spm&Bv. This is myself CACS Pushkaraj Vishnu Joshi, and we are together for the session series on this entire subject. And in today's session I will be covering the 9th module, chapter 3. So 9th module is about valuation in mergers and acquisitions, and that chapter number 3, which is acquisition outcome. So what is the outcome out of the acquisition is what I am going to cover. And as a matter of practice, I have been restricting myself to the institute material only and the chapter syllabus. So my PPT along the session will be in a way concise summarization of the entire chapter and the various concepts that have been dealt in the chapter. It's more of theoretical. The problems and solutions and illustrations that are given in the study material should be referred by you during your studies itself, and if at all a particular deep dive has to be done in a particular concept, you should refer to the respective study material. So this is more of a presentation. PPT will be an overview of the entire chapter. So begin with sorry, just a second. I opened the wrong PPT. Yeah. So acquisition outcome. So let's understand what is meant by acquisition outcome. Typically acquisition outcome, so I'll be just reading out. There is nothing much to explain about it. It's not theoretical, so complex concept as such. The performance record of acquisition is generally mixed and often disappointing. Strategic management research focuses on evaluating acquisition outcomes from the acquiring firm's perspective. A study of McKinsey and Group found that 43% of the international acquisitions fail to deliver financial returns that cover the acquirer's cost of capital. This implies that 43% of acquisition actually destroy shareholder value for the acquiring firm. The findings suggest significant risks and challenges in achieving value creation through acquisitions. So therefore, let's understand what are the acquisition outcomes per se. So the other potential acquirers includes financial economists assess mergers and acquisition impact using stock market based performance measures focusing on wealth generation. Wealth effects are derived from abnormal returns, changes in share prices of bidder and target firms adjusted for general market trends. Based on market efficiency, these abnormal returns reflect accurate market predictions of value changes from the acquisition. Study shows that overall acquisitions generate negligible or very small wealth gains. Gains are unevenly distributed, so therefore target company shareholders typically benefit while bidding company shareholders often lose. A study of 429 British acquisitions from 1980 to 1990 showed that target firms gained around 30% in value while bidders lost around 5%. So when adjusted for market capitalizations, overall wealth gain was only 2% across all cases. Therefore, let's understand the various concepts now which are covered in the chapter. Friendly mergers. So friendly mergers means the acquirer typically approaches the targets management directly to propose the merger. If both companies are receptive, they engage in merger discussions, focusing on consideration for shareholders, transaction terms, and post-merger management. Due diligence is conducted by both parties to verify financial and legal information which influence the deal's forms, terms, and pricing. So typically it's a friendly negotiation between the acquirer company and the target company. After successful due diligence and negotiations, a definitive merger agreement is signed detailing all contractual terms, warranties, covenants, and procedures. Discussion remain confidential until the agreement is signed, after which a joint press release announces the merger to the public. Shareholder approvals are usually required, especially for share-based transaction, and proxy statements are provided with full disclosures. After approvals and regulatory filings, example with Ministry of Corporate Affairs, SEBI for listed companies, the transaction is completed, consideration is paid, and the firms are legally merged. So typically these are friendly mergers process or the steps that are involved. Hostile mergers occur when the target's management or board opposes the merger proposal. The acquirer bypasses management and directly approaches target shareholders through either a tender offer or a proxy fight. In a tender offer, the acquirer offers to buy shares directly from shareholders, typically using cash or acquirer shares, other securities, or a mix. In a proxy fight, the acquirer seeks shareholder votes to replace the target's board with its own nominees, potentially leading to a friendly merger. So, proxy solicitation is subject to regulatory approval, after which proxies are mailed to shareholders for voting. Takeovers typically, in a takeover, especially a hostile tender offer, the target's board can choose to sell the company or attempt to remain independent. The decision to resist a takeover depends on the strength of takeover defenses in place, management's commitment to independence, and the premium offered over the target's current market price. Defensive measures may be used to delay the takeover, negotiate better terms, or preserve independence. Takeover defenses are typically categorized as pre-offer before a bid is made and post-offer after a bid is announced strategies. There is another concept called poison pills. Now, poison pills are defensive strategies that allow existing shareholders to buy additional shares at a discount, making a takeover more costly for the acquirer. They are designed to deter hostile takeovers by diluting the acquirer's potential ownership. Board approval is usually required, making it harder for the acquirer to proceed without cooperation. Two main types of poison pills are flip-in. So flip-in, existing shareholders excluding the acquirer can purchase more shares of the target at a discount, and flip-over includes shareholders can buy the acquirer's shares at a discount after the merger. Poison puts, these are defensive mechanisms that grant bondholders the right to sell their bonds back to the target at a pre-specified redemption price, usually at or above par value. If a takeover occurs, this strategy forces the acquirer to raise significant cash to refinance the target's debt if they proceed with the takeover. The threat of having to buy back bonds at a premium can make the takeover much more expensive and difficult for the acquirer. Share repurchase is another acquisition outcome, or in this, share repurchase is a strategy where the target company buys back its own shares from the shareholders. This can increase the cost of takeover by driving up the stock price or forcing the acquirer to raise their bid to remain competitive. If the share repurchase is financed by debt, it can result in leverage recapitalization, increasing the target's leverage and making the company less attractive to potential acquirers. Crown jewel defense is another acquisition strategy. The crown jewel defense involves the target selling off its most valuable asset or division to make itself less attractive to the acquirer. By selling these key assets, the target aims to diminish the acquirer's interest to make the takeover more costly. However, if the sale occurs after a hostile bid, there is a risk that courts could consider the sale illegal, particularly if it is viewed as an attempt to undermine the bid. Then comes white knight defense. So these are all acquisition strategies which are being discussed in this chapter. So white knight defense involves the target seeking out a third party firm, that is a white knight, to acquire the company as an alternative to the hostile acquirer. This strategy is used to bring in a more acceptable acquirer to the target's management. The arrival of the white knight can lead to a bidding war, which may result in better terms for the target's shareholders. However, the eventual acquirer may face a winner's curse, potentially overpaying for the company in the competition. Then comes the target management retrenchment. So managerial retrenchment occurs when managers take actions to boost their own job security or perceived value rather than focusing on benefiting the company. Managers may engage in such behavior if they hold little equity, and the shareholders may be too dispersed to take action against this non-value maximizing behavior. An acquirer may decide to lay off the target's management after the acquisition, particularly if the management is seen as an obstacle to value creation. Ownership stakes given to managers can increase their voting power, securing their positions and providing protection against takeover threats and competitive managerial markets. Examples of entrenchment strategies employed by managers include poison pills, which is shareholders are granted the right to purchase additional shares at discounted prices, diluting ownership and raising the cost for potential acquirer. Restricted voting rights include shares with differential voting rights are issued ensuring control remains with key promoters even if shares are transferred in some cases. Owning above a certain percentage, example 15%, may trigger loss of voting rights and require board approval for the acquirer. Golden parachutes is another strategy wherein senior management receives lucrative cash payouts if they leave the company following a merger, acting as an anti-takeover measure to discourage unwanted bids. Antitrust and security issues are there in acquisition. Historically, market share was used to assess antitrust violations where regulators provided regulators measured market power by industry concentration and competitors' market share. This method was simple. Just a second. Yeah. So antitrust and security issues historically market share was used to assess antitrust violations where regulators measured market power by industry concentration and competitors' market share. This method was simple and predictable but criticized as too rigid and simplistic. The Herfindahl and Hertzman index, pardon me for the pronunciation, HHI is considered a better measure of market concentration if it sums the squares of each company's market share based on sales. So the HHI is easy to calculate, interpret and provides a more effective model of market concentration. So HHI formula is HHI is equal to summation of sales of firm 1 divided by total sales of the market into 100 raised to 2. So square of the sum, and HHI of less than 1000 suggests a non-concentrated market, whereas an HHI between 1000 to 1800 indicates a moderately concentrated market, and an HHI above 1800 suggests a highly concentrated market. In India, the Competition Commission of India (CCI) regulates industry concentration to protect consumer interest. Post-transaction value incorporating effect of intended synergies. So in M&A transaction analysis, involves identifying the economic gains resulting from merger. If the combined entity is worth more than the sum of its individual parts, it indicates the creation of synergies. Combined value is calculated as combined value is equal to value of the acquirer plus standalone value of target plus synergy. The synergy can be diminished if the acquirer pays a premium over the target standalone value, as the synergy may only materialize if the premium is recovered. Post-transaction value incorporating effect of intended synergies, the net gain is calculated as net gain is equal to value of synergy minus premium paid minus cost of integration. Operating improvements are a major source of value creation, with post-merger integration potentially leading to abnormal returns even if the acquired company is from an unrelated business. Managerial talent plays a key role in creating value by cutting costs, boosting revenues and improving margins. Executive compensation is often tied to post-merger performance, with equity stakes aligning their interests with shareholders, encouraging them to think and act as owners. Then comes the concept of valuing control. So valuing control involves two steps. One is starting with the status quo valuation of the firm, then determining the value of control. So the status quo valuation estimates the firm's value based on its existing investment, financing and dividend policies, providing a baseline for estimating premiums for control and synergy, whereas hostile takeovers often rely on the market for corporate control, where investors are willing to pay large premiums to take control, especially if they perceive the target to the poorly managed. The value of control is higher for firms that are poorly managed or operating below optimal capacity, as it presents opportunities for management policy changes that can increase the firm's value. Control allows for actions such as acquiring or liquidating assets, changing the financing mix, re-evaluating dividend policies, Restructuring the firm to maximize value. The value of control is calculated as the value of control is equal to value of the firm into bracket optimally managed minus value of the firm with current management. Valuing synergy is in mergers and acquisition involves estimating the potential economic gains from synergies that arise from combining firms. Some experts argue that the synergy cannot be valued due to its abstract nature, with assumptions making any systematic attempt to value it difficult and unreliable. However, it is widely accepted that synergy can be valued. To assess synergy, several key questions need to be answered. What form will the synergy take? Will it reduce costs as a percentage of sales and increase profit margins? Or will it increase future growth or extend the growth period? When will synergy start affecting cash flows post-acquisition? Valuing synergy, again, for synergy to influence value, it must affect one of the 4 inputs to valuation. One is the cash flow from existing assets, higher expected growth rates, a longer growth period, and a lower cost of capital. The value of synergy is based on the present value of the cash flows it creates. Longer it takes for synergy to show up, the lower its value. Steps to value synergy includes first step, value each firm independently by discounting expected cash flows at their respective weighted average cost of capital. Step 2 is estimate the value of combined firm without synergy by adding the individual firm values from step 1. Step 3, incorporate the effects of synergy into the growth rates and cash flows and value the combined firm with synergy. Step 4, the difference between the combined value with synergy and without synergy gives the value of synergy. Exit strategies are the various exit strategies are discussed. So exit strategy involves various methods for business owners to exit their companies, including mergers and acquisitions, IPOs, selling stakes to investors, and family succession. So M&A, mergers and acquisitions, a strong exit option where owners can maintain control over price negotiations, set their own terms. M&As can be time consuming, costly, and sometimes fail. One of the strongest exit strategies for business for sale. Selling stake to an investors, another strategy. Shareholders sell their stake to partners or investors to allow the business to continue, even if the shareholders exit. Often involves a friendly buyer, someone known and trusted, helps keep business operations steady with minimal disruption. Finding the right buyer can be challenging and the business sometimes failed after M&As. Another exit strategies are acqui-hires. Acqui-hires an exit strategy where a company is bought solely to acquire its talent, beneficial for skilled employees as they are well looked after the business is sold. Another type of exit strategy is management and employee buyouts. So here management buyouts allow existing employees to transition into senior roles, filling leadership gaps, and since the management team is already familiar with the business, they are well equipped to manage it after the buyout. Then in acquisition outcome, obviously the tax implications are very critical. Let's understand that tax implications play a significant role in mergers and acquisitions and are often a primary factor influencing such transactions. Tax benefits: if the M&A is structured properly, organizations can save considerable amount of money through tax advantages. Income Tax Act of 1961, this act outlines various provisions that govern the taxation of different M&A transaction structures. Proper structuring of a M&A transaction is crucial to maximizing tax benefits and minimizing the liabilities. Amalgamation refers to the merger of 2 or more companies with another company or the merger of multiple companies to form a single new company. The key points are that all property and liabilities of the amalgamating company or companies become the property and liabilities of the amalgamated company by virtue of an amalgamation. Shareholder holding at least 3/4 in value of the shares in the amalgamating company or companies become shareholders of the amalgamated companies, other than through acquisition of property or distribution of property after winding up. So that's the definition of amalgamation as per Income Tax Act. The definition of demerger as per income tax involves the transfer of one or more undertakings from a demerged company to a resulting company as per a scheme of arrangement under the Companies Act. Key points involves all property and liabilities of the undertaking being transferred become the property and liabilities of the resulting company by virtue of the demerger. So certain liabilities and assets are demerged from and merged into another company. That's what it means. The transfer property and liabilities are valued based on the demerged company's books unless otherwise specified under Indian accounting standard. that is Ind AS, the resulting company issues its shares to the shareholders of the demerged company on a proportionate basis except in certain situations. The resulting company issues its shares to the shareholders of the demerged company on a proportionate basis except in certain situations. Shareholders holding at least 3/4 of the shares in the demerged company become shareholders of the resulting company by virtue of the demerger, excluding certain shareholding conditions. So typically these are the conditions that have been prescribed by the Income Tax Act to be constituted as a demerger per se. The transfer of undertaking occurs on a going concern basis. The demerger must comply with the conditions notified by the central government under section 72A of the Income Tax Act if applicable. Then another type of restructuring is slump sale. So slump sale refers to the transfer of one or more undertakings by any means where the transaction is for a lump sum consideration. The key point over here is in a slump sale, no individual values are assigned to the assets and liabilities being transferred, and the entire undertaking is sold as a whole for a single agreed upon price. Now let's understand the various tax exemption in case of merger and amalgamation. As a part of this session, I am just reading out the provisions because they are self-explanatory in a way and more detailed out in the presentation and summarized also over here. So under the Income Tax Act 1961, the term amalgamation is specifically defined and certain provisions provide tax exemptions for capital gains in the case of mergers and acquisitions. The key conditions for merger to qualify for tax exemption under the Act are amalgamation criteria. Assets and liabilities transfer should be there. All assets and liabilities of the amalgamating company must become the assets and liabilities of the amalgamated company immediately before the amalgamation. Shareholder approval is required. At least 3/4 of the shareholders in the amalgamating company must become shareholders of the amalgamated company, making the merger a valid amalgamation for tax purposes. Tax exemption under section 47. So capital gains exemption is given to mergers and acquisitions. Under section 47 of the Income Tax Act, certain transfers in a scheme of amalgamation are exempted from capital gains tax. Typically section 47 subsection 4 exempts transfer of capital assets by a company to its subsidiary if the parent company holds 100% of the subsidiary's share capital and the subsidiary is an Indian company. Section 47 subsection 5 exempts transfer of capital assets by a subsidiary company to its holding company under similar conditions. Section 47(6) exempts transfers in a scheme of amalgamation of capital assets by the amalgamating company to the amalgamated company if the amalgamated company is an Indian company. Under this section, sorry, just a second, there is an error. Yeah, section 47 subsection 6A exempts transfers in a scheme of amalgamation where the transfer involves shares in an Indian company from a foreign amalgamating company to a foreign amalgamated company, provided certain conditions are met. Example, 25% of the shareholders of the amalgamating company continue in the amalgamated company. There are additional exemptions given to shares of foreign companies. Exemptions also apply to transfers of shares of foreign companies in certain situations, especially if the value of the shares derives substantially from the shares of an Indian company. Banking sector, special provisions apply to banking companies, exempting transfers in a banking sector amalgamation under specific regulations. There are certain conditions for exemptions. The exemption from capital gains tax applies only when the transfer is part of a legitimate scheme of amalgamation or demerger and the resulting company or companies meet specific regulatory conditions. So in essence, the Income Tax Act encourages mergers and amalgamations by offering various tax exemptions on capital gains, provided the transaction meets specific conditions aimed at ensuring continuity and proper management of the entities involved. Then there are specific certain benefits, amortization of expenditure in case of amalgamation or demerger, section 35DT. So section 35DT of the Income Tax Act 1961 provides for the amortization of the certain expenditures incurred by an Indian company during the process of amalgamation or demerger. Here are the key provisions related to amortization. Eligible expenditure, the section applies to any expenditure that is wholly or exclusively incurred by an Indian company for the purpose of amalgamation or demerger of an undertaking. This can include expenses like legal fees, advisory fees, restructuring costs, or other costs directly related to the transaction. Second is about deduction allowance. The assessee company is allowed a deduction for such expenditure, but the deduction is spread over a period of 5 years. The company can claim a deduction equal to 1/5, that is 20% of the total expenditure for each of the 5 successive previous years. The first deduction is allowed in the previous year in which the amalgamation or demerger takes place. The tax treatment for 35DT is that this deduction helps ease the financial burden on companies undergoing amalgamation or demerger by allowing them to deduct the incurred expenditure over time instead of all at once. It reduces taxable income for each of the 5 years, spreading the tax impact. Example, if an Indian company incurs 10 lakh as expenditure on amalgamation, it can claim a deduction of 2 lakhs each year, that is 20% for 5 successive years starting from the year the amalgamation takes place. This provision aims to facilitate smoother financial planning for companies undergoing significant structural changes through amalgamation or demerger by providing them with tax relief over a period of time. Then there are certain set off and carry forward of losses and unabsorbed depreciation in case of amalgamation and merger. The Income Tax Act 1961 allows for the set off and carry forward of accumulated losses and unabsorbed depreciation in the case of amalgamation and demerger. Here are the key provisions. Amalgamation section 72 and 72AA. When one company, the amalgamating company, merges with another, the amalgamated company, the accumulated losses and unabsorbed depreciation, if any, of the amalgamating company are transferred to the amalgamated company. However, they can only be set off or carry forward if the following conditions are met. Conditions for amalgamating company. One is the business continuity. The amalgamating company must have been engaged in the business in which the accumulated loss occurred or depreciation remains unabsorbed for 3 or more years, and fixed asset ownership should be there. The amalgamating company should have held continuously for at least 2 years prior to the date of amalgamation at least 3/4 of the book value of its fixed assets on the date of amalgamation. The conditions that are required to be fulfilled for amalgamated company are that fixed asset continuity. The amalgamated company must hold at least 3/4 of the book value of fixed assets acquired from the amalgamating company for a minimum period of 5 years from the date of amalgamation. And business continuity has to be ensured. The amalgamated company must continue the business of the amalgamating company for at least 5 years from the date of amalgamation. Genuine business purpose should be there. The amalgamation must be for a genuine business purpose, and the company must meet other conditions prescribed by the tax authorities to ensure this. Time period for the carry forward is that business losses, the business losses of the amalgamating company can be carried forward by the amalgamated company for up to 8 years, and unabsorbed depreciation, the unabsorbed depreciation can be carried forward indefinitely provided the conditions are satisfied. Now in case of demerger, so this was in case of amalgamation, and in case of demerger, where a part of the company is transferred to another entity, the accumulated losses and unabsorbed depreciation of the demerged company can be carried forward and set off by the resulting company subject to the following conditions. So the conditions for the resulting company are accumulated losses and unabsorbed depreciation. The accumulated losses and unabsorbed depreciation of the demerged company will be carried forward in the hands of resulting company subject to certain conditions to those in amalgamation. Carrying forward of losses, the business loss of the demerged company may be carried forward for the remaining unexpired period up to 8 years, and unabsorbed depreciation can be carried forward indefinitely in the hands of the resulting company. So broadly, to summarize, set off and carry forward of losses and unabsorbed depreciation in case of amalgamation and merger. For both amalgamation and demerger, accumulated business losses and unabsorbed depreciation can be carried forward provided the prescribed conditions related to the business continuity, asset holding and genuine business purposes are satisfied. In case of amalgamation, business loss can be carried forward for up to 8 years, while unabsorbed depreciation can be carried forward indefinitely For demergers, business loss can be carried forward for the unexpired period, and the unabsorbed depreciation can also be carried forward indefinitely. This set off and carry forward provision ensures that companies undergoing mergers or demergers are not unduly penalized or for losses incurred before the restructuring, allowing the new entity to benefit from the accumulated losses and depreciation for tax purposes, and thereby motivate the various organizations to get into corporate restructuring by way of amalgamation and demerger also. In the context of demergers, the carry forward of taxes, tax losses and unabsorbed depreciation depends on the relationship between the demerged company, the company transferring part of its business, and the resulting company, the company receiving the transferred businesses. Here are the key points to understand. Direct relationship between the companies. So direct relationship, if the resulting company and the demerged company have a direct relationship with the transferred undertaking, the accumulated tax losses and unabsorbed depreciation of the demerged company can be carried forward by the resulting company. The losses and unabsorbed depreciation are transferred to the resulting company based on their relationship to the specific undertaking being transferred. No direct relation between the company. In that case, segregation of losses and depreciation. If there is no direct relation between the demerged company and the resulting company, the tax losses and unabsorbed depreciation must be segregated between the demerging company and the resulting company in the same proportion as the assets being transferred. This segregation allows the same percentage of as the division of the assets between the two entities. In other words, if the demerged company transfers a certain percentage of its assets to the resulting company, the accumulated losses and unabsorbed depreciation will be divided in the same proportion. Cost of assets and depreciation. The opening written down value of the transferred asset is carried over from the demerged company to the resulting company at the same value. This ensures continuity in the tax treatment of the transferred assets, especially regarding depreciation. Then comes the tax deduction for demerger expenses. The demerged company can claim a deduction for the tax expenses incurred during the demerger transaction. The tax benefit is spread equally over 5 years starting from the year in which the demerger takes place. So summary of key points: direct relations. If there is a direct relation between the demerged and resulting companies, the tax losses and unabsorbed depreciation are carried forward by the resulting company. If there is no direct relationship, the losses and depreciation are divided in the same proportion as the assets transferred. There is a depreciation continuity. The opening written down value of the assets transferred is maintained in the resulting company's books, and demerger expenses. The merging company is entitled to a tax deduction for the expenses incurred in the demerger, which is spread over 5 years starting from the year the demerger occurs. So in a way, this ensures that the tax consequences of the demerger are properly addressed and the business continuity is maintained, allowing the resulting company to continue benefiting from the losses and depreciation from the transferred undertaking. Slump sale and taxation. So key insights: typically a slump sale involves the transfer of an entire business or undertaking for a lump sum consideration without breaking down the value assigned to individual assets or liabilities. Here how it is treated for taxation purposes. So capital gains in slump sale, calculation of capital gains. The gains in a slump sale are computed by finding the difference between sale consideration after deducting any expenses related to transfer, the net worth of the undertaking being transferred. Fair market value consideration. According to Finance Act 2021, if the slump sale consideration is lower than the fair market value of the asset transfer, the FMV will be used as a full value of consideration for computing capital gains. This is in accordance with the Rule 11 UAE of the income tax rules. Tax exemption in amalgamation includes transfer of capital assets. In a scheme of amalgamation where the amalgamated company is an Indian company, any transfer of capital assets from the amalgamated company to the amalgamated company is exempt from tax. Transfer of shares: if a shareholder transfers shares in consideration for receiving shares in the amalgamated company and not the amalgamated company itself, capital gains tax will not be levied. This applies when the amalgamated company is an Indian company. Acquisition cost of shares: for such shareholders, the acquisition cost of shares in the amalgamated company will be the same as the cost at which the shares of the amalgamating company were acquired. The holding period of the shares will include the time the shares were held by the shareholders in the amalgamating company. The tax exemption in foreign companies amalgamation in cases where there is a transfer of shares of an Indian company in the amalgamation between two foreign companies, certain conditions apply for the tax exemption. One is 25% shareholders rule. At least 25% of the shareholders of the amalgamating foreign company must continue as shareholders in the amalgamated foreign company, and no capital gains tax is in an amalgamation company. If the country where the amalgamating foreign company is incorporated does not levy capital gains tax in such amalgamations, tax exemption on capital gains can be availed in India. Then indirect taxes in mergers and amalgamations. So GST applicability, since mergers and amalgamations typically involve a transfer of business on going concern basis, GST is generally not applicable. However, as per section 18(3) of CGST Act 2017, certain conditions permit the transfer of unutilized input tax credit in the case of change in constitution due to amalgamation. Stamp duty in India. Stamp duty is imposed in the execution of legal documents including sale deeds and deeds of conveyance. While the central government enacts the Indian Stamp Act of 1899, individual states in India may have their own stamp duty acts. In case of amalgamation, stamp duty may be applicable on the transfer of assets and other related legal documentation depending on the state specific regulations. The summary of key points in this case are: slump sale involves lump sum consideration for the transfer of entire undertaking with capital gains calculated based on the sales consideration and net worth of the undertaking. The FMB may be considered in certain cases. Amalgamation exemption for capital assets transferred between Indian companies. Shareholders tax, no capital gains for shareholders receiving shares in the amalgamated company, and the cost of acquisition is based on the original shares. Foreign amalgamations exemption can be claimed if 25% of the shareholders continue in the amalgamated foreign company. And the country of incorporation does not tax the capital gains. GST generally not applicable in amalgamations, but input tax credit may transfer may be allowed under certain conditions. Stamp duty is payable on documents like sale and conveyance deeds subject to central and state stamp duty regulations. This ensures that tax implications are addressed and comprehensively during slump sales, amalgamation and demergers with specific rules on capital gains, GST and stamp duty in India. So with this, the chapter gets ended, and thereafter, as a matter of practice, there are short answers, question and answers. One deals with friendly merger and due diligence. In that, the concept, the acquirer directly approaches the target's management. Discussions include consideration amount, transaction terms and post-merger management. Both companies conduct financial and legal due diligence to verify accuracy of records, and the target may also assess the acquirer's financial health and ability to meet the payment terms. Question number 2 deals with hostile merger versus defensive strategies. So targets management raises the merger, prompting the acquirer to approach shareholders. Acquirer may use a tender offer or proxy fight to take control. Defensive strategies include poison pills, share repurchases, crown jewel defense, white knight defense to delay or block the takeover. Managerial retrenchment and strategies was discussed in question 3. Managers take decisions to ensure their positions rather than focus on shareholder wealth. Example includes poison pills, diluting the company to increase acquisition cost, and golden parachutes, wherein lucrative severance for executives to deter takeovers. Short question 4 dealt with abnormal returns in unrelated business acquisitions. Even in unrelated businesses, successful post-merger integration can yield abnormal returns. Key actions include cost cutting, revenue improvement, restructuring, resource reallocation, and operational efficiency. Aligning executive compensation with post-merger performance and incentivize actions that benefit shareholders. The fifth answer was dealt with antitrust and security issues in mergers and acquisitions. Herfindahl and Hirschman Index HHI measures market concentration and assess merger impact. Regulatory bodies like Competition Commission of India monitor industry concentration, and mergers exceeding market thresholds may face challenges or investigations from regulators. In short, question and answer 6 has dealt with valuing control in acquisition. So valuing control estimates the value increase from changes in management post acquisition. calculated as the difference between value of a firm with optimal management and the value under current management. So with this, we come to the end of the chapter, and quickly as a part of the summarization, what all we have covered, I will wrap up the session by walking you through what all has been covered at a broader level. So we started with the chapter 8.2, which is about acquisition, sorry, not 8.2, pardon me, it's 9, valuation in mergers and acquisitions. Yeah, so to wrap up, in a way, we saw what is the performance records of acquisition in generally mixed and often disappointing. Then we saw the strategic management research, the McKinsey study, that 43% of internal acquisitions fail to deliver. Then we went through other potential acquirers. Then we saw friendly mergers, what they meant, what are meant by hostile mergers, what is meant by takeovers, what is meant by poison pills, poison puts, then share repurchase, crown jewel defense, then we saw white knight defense, then we saw target management entrenchment, then examples of entrenchment strategies employed by managers, which includes poison pills, restricted voting rights and golden parachutes. Then we went through antitrust and securities issues. We saw HHI model, the HHI formula also we saw, and the HHI matrix. In India, the Competition Commission of India regulates industry concentration to protect consumer interest. Then we saw post-transaction value incorporating effect of intended synergies, mergers and M&A's transaction analysis. Then we saw post-transaction value incorporating effect of intended synergies, valuing control, then valuing synergy, steps of value synergy, then various exit strategies we saw, which includes mergers and acquisitions, selling stake to an investor, acquire hires, and management and employee buyouts. Then in detail we went through tax implications, amalgamation, demerger, slum sale, then tax exemptions in all these cases of merger, amalgamation, slum sale, capital gains exemption, additional exemptions, conditions that are required to be applied. Then we saw amortization of expenditure in case of mergers and acquisitions and demergers, the tax treatment, then set off and carry forward of losses and unabsorbed depreciation in case of amalgamation and demerger. Then we saw the carry forward of tax losses and unabsorbed depreciation in case of demerger. Then we saw slum sale and the taxation insights, the tax exemption in amalgamation, the tax exemption in foreign companies amalgamation, then indirect taxes in mergers and acquisitions, how the applicability is stamp duty wise also. Then we went through various short answer, which first dealt with friendly mergers and due diligence, hostile mergers and defensive strategies, managerial entrenchment and strategies, abnormal returns in unrelated business acquisitions. Then it dealt with antitrust and securities issues in mergers and acquisition, and lastly valuing control in acquisitions. So with this, in a way, we end the session and the chapter also. So signing off here, CACS Pushkaraj Vishnu Joshi. So with this, we have completed the 9th module also. It's a long chapter. And signing off here, CACS Pushkaraj Vishnu Joshi. See you in the next session. Bye bye. Take care. Keep studying. Keep following the study material. The sessions have been covered to quickly give summarization of the entire chapter, which is in detail covered in the study material which has been provided by the institute. So kindly refer these notes or PPT or the session also along with the study material is my humble submission as a from the examination perspective. So and so that you are able to score good marks in your examination. And mind well, ensure to go through each and every illustration, each and every problem and solutions, and each and every question and answer that has been given in the study material at the end of the chapter. Including in chapter, there are various examples and illustrations that are solved. Please go through in detail each and every example and illustration therein. So signing off here, CACS Pushkaraj Vishnu Joshi. See you in the next session.